Hello and welcome to the WARC Podcast. My name's Alex Brownsell and I'm the head of content for WARC Media. Today we're going to be examining the health of the global ad market and finding out what impact the growing trade wars between the US and other countries is having on advertising investment. Each quarter, WARC Media sizes up the state of worldwide ad investment and the latest forecast is just out. I'm delighted to say that the man behind the numbers joins us on today's podcast. Welcome, James McDonald, WARC's Director of Data, Intelligence and Forecasting. Hi, James.
Hi, good to be with you.
It's great to have you here. It's very timely. You're the man that we need to help us understand what's going on at the moment, and certainly as it relates to the ad industry. We're going to be sharing 4 key big trends from the latest data release. So, let's just get started and let's examine the big picture. So last year was a blockbuster 12 months for the global ad market in terms of double-digit growth. And last autumn, we forecast that momentum would largely continue into 2025. How are things looking now as we entered the second quarter, and how much impact are Trump's tariffs having on spend?
So in a word, things are looking quite ropey at the moment. We've cut our growth forecast by about $20 billion over the next 2 years. Moving into the second quarter, ad market growth is already starting to ease to about 7.5%. And while that sounds quite healthy, it compares to about 11% growth average across last year. So we're already starting to see a slowdown, which is born out of hesitancy to commit ad budgets because of the volatility in trading conditions at the moment. We think the growth rate is going to ease close to 5% next year as the impact of these tariffs begin to bite. So as I mentioned, the introduction of tariffs is already having an impact on media buyers and strategists' hesitancy to commit budgets, especially around big brand building campaigns. And this is particularly true for the sectors that are perhaps most in the firing line for these tariffs. So things like automotive, pharma, consumer packaged goods, all of that stuff.
Yeah, no, absolutely. Well, we'll get into the categories in just a minute. But I'm going to put you on the spot slightly. I'm interested to know, when you're looking at such a volatile economic state and you're trying to sort of forecast it with confidence as you possibly can what's happening in the year ahead, do you look at multiple scenarios? How do you kind of evaluate what might happen and the likelihood of different situations?
Yeah, so for this piece in particular, we've actually produced 3 different forecasts. We weren't content with just the one. We thought we'd triple the output this time. So WARC leverages a machine learning model that we've developed over recent years, actually since the wake of COVID, because things were developing so quickly at that time. Any forecasts that were being produced by the market were quickly becoming out of date. And interestingly, I think the pace of change at the moment is akin to that time. So the model that we built then is now being heavily leveraged, and this model factors in things like advertising spend, as you'd expect, over 100 markets worldwide over the last 4 decades, but also macroeconomic indicators, so GDP, inflation, consumer spend, as well as media consumption and media costs, CPMs. So all of these things combined allow us to paint a picture of what the future may look like. So our base case is that the ad market will grow 6.7% this year. And that's based on current macroeconomic indicators. To complement that base case forecast, we also produced 2 more forecasts. One is based on an OECD scenario, which assumes that 10% tariffs will be introduced across the board, and that this in turn will remove half a point from GDP growth in key markets, as well as adding about 0.4 percentage points to inflation. In that scenario, if we applied it to the global ad market, growth would ease back to 6.3%, so compared to our 6.7%, a bit lower. We then gained a final scenario which was a little bit bleaker, which actually assumed 20% tariffs, and a whole point being removed from GDP. This eased global ad growth down to about 5.9%. I think as we're recording this, the US president is now introducing 20% tariffs. So that severe case, which brings the market down to 5.9%, is now becoming the reality, and may indeed be revised in our summer forecast in July.
Yeah, absolutely. Well, this is the thing. Obviously, it's a moving picture, and anything that happens now, we don't necessarily what's going to happen later today, let alone next week or further ahead with the current US administration. But from your perspective, what we're doing and the systems that we built allow us to then follow the market on a almost real time basis and start to understand the impact of these things much more quickly than we would have done once upon a time.
Yes, indeed, and that's a crucial tool for our clients to be able to use in order to understand what the future will look like when the sands are shifting so quickly underfoot. Advertisers need to be bold, they need to be brave, they need to identify market opportunities. And in order to do that, you need up-to-date information. So this forecasting model really plays into that capability.
Yeah, absolutely. Well, let's dig into the trends at the category level that you started talking about earlier. Certain parts of the economy are likely to be more impacted by the economic headwinds than others. You mentioned automotive. We've seen those pictures of cars being stockpiled somewhere in Baltimore. These really are crazy days. So, which parts of the advertising ecosystem are most likely to dial down spend, do we think, as a result of the current situation?
So our working assumption is that all product sectors will be impacted in some way. The impacts will be felt, will be more pronounced among some sectors than others, but all sectors will feel an impact. To pick out three that we focused on as kind of particularly exposed to what's happening at the moment, automotive, as you say, is a prime one, not least because some of the punitive tariffs have been directed specifically at the automotive sector, but residual tariffs around aluminium and steel stand to increase manufacturing costs and tighten margins. We've actually seen advertising budgets being reduced by key players like General Motors and Ford. So the amount that these companies reinvest in advertising as a proportion of what they're making in sales has gradually diminished over recent times. So that's already been a trend before all of this disruption, and we think this will only exacerbate that. So historically, automotive has been a big spender on TV, and so any disruption to those supply chains and those margins could bear out as an impact on TV advertising, which typically commands a higher cost. However, I think it's interesting to note that almost half of automotive spend is now spent on what is kind of broadly referred to as performance formats, so things like paid search, social media, etc. So these budgets also stand to be threatened by tariffs. So yeah, the picture's challenging for auto. It's also compounded by the manufacturing of microchips, which will impact the tech and electronics sector, but will also hit automotive, as it did in the pandemic, actually. So in much the same way.
It's interesting, isn't it? Because tech, we've talked about this or written about this quite a bit on WARC Media, has kind of come from automotive, the CPG. These have been the sort of the bulwarks of the advertising market in terms of where the spend has come from. But the tech sector has really come up in the last couple of years to the point where Amazon was the number one advertiser in terms of expenditure in the world, and others were sort of significantly increased their expenditure as well. Are we seeing a softening then from that sector generally as some of these trends that you're talking about are playing out?
Yeah, certainly. So I think part of the big reason for the boom in the tech sector was digital native startups getting a lot of seed capital at very, very low interest rates. This allowed them to grow very rapidly and then funnel a lot of that money back into advertising. As rates increased, a lot of companies went under. It's quite brutal at one point, wasn't it? And more broadly, the sector has been squeezed. So that has then transferred into advertising budgets and outlay on advertising spend, as you might expect. We still expect the tech sector to grow in terms of its advertising spend this year, but the rate of growth will probably be about half what we were forecasting in November. So that's quite a dramatic change, actually, in just the last 3 months, and is really a sign of the times at the moment.
And more broadly, if we look at like what we're seeing with some of the categories that maybe aren't likely to be as immediately influenced by supply chain issues, is that potentially a bit of a movable feast that they're going to respond to consumer situation and consumer demand rather than reacting immediately to what they're seeing from, in terms of tariffs and trade wars?
Yeah, I think these brands will always need to react to consumer appetite. Tariffs seem like some kind of existential, ominous, looming threat that kind of, is always there. But actually what these brands are feeling on the ground and the demand, particularly for retail media platforms as well, is what they need to calibrate their advertising budgets towards. So while we're talking about a lot of doom and gloom, there are also opportunities here for certain brands.
It's been a pretty great time to be a social media platform, a retail media network, sellers of advertising in certain parts of the ad market. How do we see the slowdown in spend likely to impact at a channel level? Is this going to be distributed evenly, or are there going to be parts of the market that suffer more than others?
Yeah, so our working assumption is that legacy media will be most at risk. Typically, what WARC has observed during times of economic hardship is that advertising budgets will shift from what are commonly referred to as brand building exercises, which are kind of the preserve of media like TV and out of home, and into performance formats that are transacted on a cost per click basis, so things like paid search and social media. This is dangerous, by the way, because all of the WARC research we've produced shows that actually you need a very well balanced blend of media in your mix in order to be most effective. So shifting all of your money from one pot to another can actually be really detrimental over the long term. But we do feel that legacy media will bear the brunt of this because the costs are generally higher. That's not to say that the online platforms aren't exposed, but we think that the impact will be lesser.
It's an interesting one, isn't it? Because we know that Meta, for instance, in particular, has really benefited from advertising from Asian and specifically Chinese companies targeting consumers in Western, particularly the US market. Temu, Shein, for instance. As the tariffs potentially start to hit those companies, is that a big threat for like a Meta, or are they just significantly diversified in terms of their customer base that actually they don't need to be too worried?
I think it's a sizable portion of their advertising base. Well, one thing we saw last year actually were two companies in particular, Temu and Shein, really aggressive advertising strategies, flooding a lot of money into online channels to the point where they accounted for a sizable portion of the retail category growth last year. So yes, I think barriers to their access to Western consumers will manifest in lower advertising outlay. I think the same is also true beyond Meta. I think the same is also true for retailers. So companies like Amazon, also Walmart and Costco, a sizable proportion, in some cases, well over half of their suppliers are Chinese. So any disruption to that supply chain is going to have an impact on probably prices at the till, but also the amount that these suppliers are advertising in retail media environments.
Yeah, well, it is interesting to see actually the chart that you produced where you compared the November forecast with your most recent numbers. And needless to say, in the majority of channels, either we saw parity or we saw a slowdown in forecasted growth. Retail media and acceleration, because of what we're seeing, or is there no real causality between what we're seeing in retail media and the economic situation?
Retail media definitely bears a relation to the wider economic picture. The reason we've uprated growth, though, is that there are more entrants into the retail media space. So the term retail media, its definition is broadening almost by the day, it seems. There are players in automotive and companies like Uber who are now, data brokers in the commerce media space. And within the WARC Media platform, obviously, we focus a lot of attention on retail media and how that space is evolving. But
absolutely.
But the growth in that sector is continuing unabated, partially because it's still nascent, it's still evolving, but it's certainly not immune and insulated from wider economic factors.
And finally, we've skirted around this, and we should probably grasp this particular nettle. And full disclosure, listeners, we are recording before the 5th of April. If we assume that TikTok, as we are assuming that TikTok is given some sort of state execution or some knight in shining armor arrives to maintain its US operations, what are we seeing there? How are we seeing its ad business perform in the context of not just macroeconomic uncertainty, but very specific uncertainty about whether or not it's even able to operate?
Yeah, so our working assumption is that TikTok will continue to exist in some form or another in the US beyond the date that was set by the court. The US is by far and away TikTok's biggest market. It makes about $12 billion in advertising revenue from the US alone each year. Or will do this year, we believe. In terms of its growth prospects, we think that it can achieve growth of 24% this year. The old adage remains true, regardless of the format or the platform or the medium. The money will follow the eyeballs. And as we know, younger consumers are most desirable because they are still forming habits around purchasing and opinions towards brand and brand equity. So being seen in front of that audience is of high priority to the majority of advertisers, depending on their brand positioning. I think a lot of strategists would eyebrows would be raised if a strategist didn't have a TikTok plan as part of their planning. So our working assumption is that TikTok will continue to grow, although we did some interesting research recently to game what would happen if there was a ban on the platform. And we found that as much as 40% of TikTok's US revenue could go to Instagram, with a further 20% going to YouTube as part of its shorts format, which YouTube developed to directly counter TikTok. So the money could shift around, but at the moment we're believing that it will continue to stay with TikTok and indeed grow quite healthily this year.
Yeah, recommend anybody to go onto the WARC website and check out the octopus chart, as we're fondly calling it, which kind of shows where the money we think would go between Q1 and Q3. Finally, and we've been talking in very global terms here about the worldwide market, I think it'd be useful for our listeners to contextualize some of these trends at a local level, a market level. And let's start with the big two, the US and China, who also happen to be the two prime antagonists in the current trade war. What impact are we seeing on spend in those markets?
Yeah, so prime antagonist is right. The US accounts for $2 in $5 spent on advertising worldwide. So its fortunes bear a heavy relation to the wide global market. We think the US ad market will grow by 5.7% this year. That's healthy because in our measure of spend in the US, we include things like political spend, and we also include residual spend around sporting events like the Olympics. So as you can imagine, last year was a bumpy year because we had the presidential elections and also an Olympics. But so to register 5.7% growth this year is actually very, very healthy indeed. The OECD also cut the US GDP growth forecast this year. So to post growth of around 6% is not too bad at all. And indeed, we think that rate will increase next year, not least because the World Cup will be held across North America, which should buoy TV spend in particular. So generally, things looking pretty healthy for the US. In China, growth is also expected to be decent, although interestingly behind the US, so at 5.3% growth this year, and that's very slow by historic standards in China. The Chinese market is still grasping with weak domestic demand. And I think we were talking about Temu and Shein earlier. The fact that Chinese brands are reaching out to Western consumers is very much a symptom of that weak domestic demand. So that isn't really going away. And so we expect the Chinese growth to be close to 5% this year and indeed just 4% in 2026.
And how about some of the other sort of the bigger ad markets that we track? Where are we seeing growth soften the most and where is spend looking a little bit more resilient?
Yeah, so in Europe on the mainland, growth is quite muted. Germany, which is Europe's largest advertising market, is close to recession. Also a big automaker as well, which is obviously quite timely given current events. So the German ad market is posting very slow growth. The UK, on the other hand, economic growth prospects are very poor. Speaking as a UK consumer, I think we're all kind of feeling it at the moment. But the ad market is doing relatively well by comparison. The UK's ad market is highly digital, so over 3/4 of the ad market is online. And so the fortunes of certain online companies have a heavy bearing on the UK's ad market in the round. So growth is expected to be decent this year in the UK. And last but not least, Japan, which is the world's fourth largest market, is expected to actually see a decline when measured in US dollars, I should add. So in yen, growth is very, very meek, but in dollars, it's actually down. And that's a reflection of how strong the greenback is against the yen at the moment.
Well, thank you, James. Really appreciate you running us through what we're seeing. I suspect this is going to be a moving picture, and we're going to be coming to you again very shortly once we've got a little bit more clarity on what the US administration is doing. But for anybody listening, if you want to go and take a look at the latest numbers, they're available on the WARC website, and WARC Media subscribers can access a long read piece from James where he really goes into all of these in significant depth. But thank you, James. It's been great chatting.
Pleasure.
Well, that's all we've got time for today. If you like what you've heard, please do follow us on your favourite podcasting platform. And if you really liked it, please go on and leave us a review. Until next time, thanks for listening.